Do I want to spend the rest of my life being a Ubered passenger? No, I do not. But I'm going through what you would call consumption smoothing. I am smoothing out my economics because some things are not going that great for me economically, and so I have to take from somewhere else to fix that. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code-cracking stuff, folks. We're going to dig into consumption smoothing, what that actually means, why we should be smooth. Let's talk smooth today. So welcome back, regulars. We're going to crack that code. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are lessons on real estate, so feel free to go back in time if learning about consumption smoothing doesn't ultimately rock your boat. But hey, folks, I've got 33 minutes to do this podcast. Yes, I'm on a podcast timer today because I have another meeting. My day is not smooth. But today we want to talk about smoothing, what that actually means, and I guess the concept economically of consumption smoothing, the idea that you as a human being are going to have moments in your life where you have to reevaluate what you spend, a bit of an input-output equation. So what is really the concept of consumption smoothing? The idea, economically speaking, is if we take on debt when we're young, that economic concept of borrowing money and getting into housing and buying assets and becoming a capitalist will smooth out over your life journey. In other words, if you invest early, you're going to end up in a place later in life where your investments take care of you. There's going to be a smoothing out effect over a timeline. And of course, economically speaking, we earn money at different times of our life. When we start out in our teens, we are basically little slaves. When we get into our 20s, we're starting to earn a little bit of money. And then as we find a career and progress in life, we should be earning more. And quite often our peak level of earnings is age 44. And then we start to even go into just a stagnation period of what we can earn from a job. But consumption smoothing is really the concept that economically we have to change our behaviors to economically mirror the world we live in. And consumption smoothing, in some respects, absolutely fails for most people. Now, recently, I am going through some consumption smoothing. Yes, I had a sports car, quite a fun sports car. And because it was a sports car, it's kind of like a bit of a weekender. And I started to do other things on my weekend and started to realize I probably don't need this sports car because economically speaking right now, things are a little bit tougher in real estate. I'm not making as much money as I was previously. So I've got to make an economic smooth decision. Do I really need this car? And can I go carless? And I decided to smooth out my life and basically remove one economic burden on my life from my life. And I sold that car. So now I don't have a car. Yes, I ride in the back of Camrys now. In fact, I am basically Uber's passenger. So do I like being Uber's passenger? Well, no, I don't, actually. I think it's horrible. Most of the Camrys are not pleasant to get into whatsoever. Half of them I feel sick and giddy being driven around in. The other half kind of stink. So do I want to spend the rest of my life being a Ubered passenger? No, I do not. But I'm going through what you would call consumption smoothing. I am smoothing out my economics because some things are not going that great for me economically, and so I have to take from somewhere else to fix that. And for a lot of people, going through that exercise of consumption smoothing is just a real bit of economic difficulty for them. It's psychologically very, very difficult to do what I am doing right now. Most people would do something completely different when it comes to giving up something in their world. And so a lot of people often ask me, like, how do you build a portfolio of properties? And to be honest, a lot of it is about what you're personally willing to give up to get to the finish line, because becoming wealthy is often a game of frugality, what you can actually give up to get where you need to go. Now, for human beings, we often have this justification mindset. We'll fall into a psychological dialogue with ourselves that we can work out how to pay for something later. And we justify a lot of our emotional decisions in the marketplace. And so, we'll justify buying a new shirt when we've got 20 in the closet. We'll justify going on a holiday when, an expensive holiday, when really we probably can only afford to go away for the weekend. So we live in a justification marketplace, and a lot of that is driven off the back of a credit-funded lifestyle. Now, when I was growing up, credit was a lot more difficult, and you saw that ultimately in the car market. Most people drove a bomb. Yes, typically your mum's arm was a seatbelt when I was growing up. There was no such thing as safety in cars, and each car looked pretty horrible. They were rust buckets, effectively. But then came along credit, and everyone ultimately could go out and buy a car. You don't actually have any money when you go car shopping. Most people have $1,000, and they end up taking home $100,000 motor vehicle that they're paying $700, $800, $900 a month for, $1,000 a month, $1,500 a month for. And what happens is this credit-funded lifestyle actually needs to be compensated somewhere else by way of the economic principle, consumption smoothing. But people don't smooth out their life. So what happens is they just end up in a place where they're credit funded. They look like their life is marvelous and they've got all these things and stuff. But economically speaking, they're going to pay the piper somewhere else in their life because of too much bad debt coming into their world. And here in Australia, bad debt is just rife. Like Australians basically almost owe more than they have constantly due to a credit-funded lifestyle. And you see that now with things like Afterpay as well. Like people don't economically smooth out their life and consume through smoothness. They just take on credit. Like Afterpay is one of the craziest things in my mind that can ultimately exist. If you can't afford the pair of shoes today, why would you go and Afterpay it? But this is the society we live in because the justification mindset is real for people. And so people justify everything. That we human beings can come up with a bias to justify just about anything we want to do. And so if you study really wealthy people, quite often they're quite frugal. You wouldn't even know they're wealthy. And that is one of the challenges with the concept of consumption smoothing. Now, I'm going through this at the moment where I'm almost starting to go, I can't get in the back of another Camry, and I need to do something that will make my life less boring. And it's all to do with my psychology. And again, like, I liked having a sports car. I liked it. But now I've gone to the boring Uber to consumption smooth where I am economically. Now, I could simply sell a property and cash in $500,000, $1 million on a property deal and go from basically having a bit of a boring time driving a car or not having a car to having a exciting existence. And one of the things I personally struggle with is one of my highest values is not to live a boring life. I enjoy doing things. I enjoy having fun. And so I'm going through this kind of economic smoothing conundrum at the moment. And in real estate, we often see this because in real estate, there are kind of three phases to investment. There's your acquisition phase where you take on a lot of debt and you have to give up something to accommodate that debt. Then you've got your consolidation period where you work out how to eliminate debt. And then you've got this legacy piece where you get to live off the fruits of your labor, and consumption smoothing evens out later in your life when you're much older. I guess the economic principle is a great principle, but then all of a sudden psychology plays a part and you start to justify, well, do I really want a boring life up until I'm 65 years of age and then to start living? And certainly we are not, I guess, rational robots to go through that experience of life like that. So in some respects, all of us are, I guess, subject to consumption smoothing. And there are always unexpected things that pop up in your life. And, you know, right now, not a lot of people are investing in real estate as much as they were 3 years ago. So an unexpected diagnostic of my life is I earn less money. And so I've got to I can consumption smooth through two vehicles. I can be frugal, like not have a car, or I could go the opposite direction. And because I've pre-planned through investing earlier on in my life, I could actually go the opposite direction and sell off an asset, cut off a limb of my economic moat, and go through the principle of not earning as much as I would like to right now, and use an asset to fund that. And so that's just life. And life is about smoothing out your economics over your economic life cycle. That's the reality of it. So the point of today's conversation is to work out what levers you've got and what you're willing to sacrifice to get through and go through your life journey. And without assets, it's very hard to ultimately play this game. And that is why economic smoothing exists as a principle and why it is very important to add assets to your journey, because you never know what's around the corner. You never know if something's going to jump out and smack you in the face. And of course, this is why we need very good wealth building habits, and why, the concept of getting educated and listening to podcasts and having spreadsheets and running profit and losses on your own economics is very, very important. Understanding your input-output equation is paramount. And of course, for a lot of people, they just don't have wealth-building habits to help them and guide them to get to the finish line. And so what happens is they never, ever get in a place of economic smoothness, of consumption smoothness, and they consume out of control, and to a point where they are just totally removed from the levers of building an economic moat. And of course, we live in a world where economically factors externally come into our world. I mean, I was just buying some fish at the fishmonger yesterday, 750 grams of salmon. It was $66. Like, economically, that seems like a lot for 750 grams of salmon, which is probably farmed in, someone's backyard. So we live in a world now where consumption smoothing is going to be a factor of how you invest. What are you willing to give up to get to where you need to go? Are you going to be like me, driving around the back of an Uber? What are you willing to give up? Because inflation is not going to go back to the way it ever was. The next 10 years, we're going to live in really an economic way where things generally cost more, and there's going to be a lot of VUCA, a lot of volatility, uncertainty and ambiguity in the next 10 years of economics. So again, like, you can pull some levers to economically smooth out your world. You can take and cash in an asset if you have it, which I'm actually considering doing because of my psychology around a boring life. Like, I'm like, how long can I go in the back of a Camry? Maybe we should study how long I can actually make it in the back of a Camry before I pull a lever and go, psychologically, I cannot consume smoothly. And I'm not a perfect human being. I've certainly got my flaws, and I like an exciting life. And so I want to be a property investor, but I also want to enjoy the journey along the way. And if I study my life, my economic frugal period of my life was from age 18 to around 35 years of age. I was very much not part of a, credit society, in the respect that I drove a bomb. My first car was an Austin 1800. It cost me $1,200. My next car was a broken down Volvo, which was the ugliest car in the world. It cost another $1,200. I've owned so many bad cars along the way rather than get a car loan. And I've done other very frugal things to economically smooth out my life. My consumption in my first sort of 20 years of my economic life, let's say, was very, very frugal based. I would not take on bad debt. And I can see the benefits of that smoothing out now when, economically speaking, I can do different things to change my life. I can offload an asset to improve my living standard. But I still have gone down the road of credit, frugalness when it comes to bad debt. I tend to avoid bad debt. And again, even with things like cars, I tend to pay for them in cash and remove them from my life if I need to. And so that's the concept. And I guess if we were to look at where Australia is at the moment, I think there's a lot of consumption smoothing that needs to filter its way through the economy. I still see the cash rate at a level whereby Australians are still spending. There's still a decent amount of retail activity. There's still jobs growth in the marketplace, and there's still inflation. So I think the Reserve Bank has basically struggled with going harder on the Australian economy because of the services nature of the Australian economy and the consumption nature of Australia's economy. So inflation may be a bit stickier here in Australia than in other countries where the cash rate has been a lot higher for a lot longer than here in Australia. And, if you were to look at, for example, the United States of America, their cash rate has topped out at 5.5%, Australia at 4.35%. And you could go to, the United Kingdom at 5.25%. So what's happened over there is in those countries, the Reserve Bank of those countries, the Federal Reserve of those countries have pushed the cost of money up so high that it's created a downturn of consumption smoothing. And people have felt it to the point where they've changed their behavior and they've given up stuff to balance this principle of smoothing out economics. Here in Australia, I think we're hedging that we don't need to go through an economic smoothness of kind. And for our cash rate is at 4.35%, which is considered very low compared to the rest of most OECD countries around the world. In other words, we haven't gone at smashing inflation as hard as the rest of the world. And my belief is it's because of our inability to psychologically do things tough here in Australia. We love a credit-funded lifestyle. We love, we love that we need to go and spend, and our society is built on services spending. So it's very, very difficult for the Reserve Bank to undo the economics of Australia by asking people to spend less effectively. And so it may just mean we're in a rate cycle of the fours for a little bit longer than most people would hope. Even though the forecast is for a rate cut early next year, the spending probably needs to slow down. And again, what that looks like is maybe certainly a different approach economically in everyone's household to economically smooth out where we are as a country. Maybe spending less right now would be a better version of playing the game. And I guess consumption smoothing is difficult for people to stop because once we get used to something as human beings, it's hard to give it up. Now, as a human being, once I had never flown business class and I didn't know any better that there was this wonderful thing at the front of the plane. And once you have a taste of that, it's very, very difficult to go back to economy. And again, this is a very, very interesting way to analyze consumption smoothing, because once human beings have a taste of something, whether it's business class on a plane or whether it's 3 holidays a year or whether it's, dressing a certain way or going out 3 times a week, it's very, very difficult for people to stop that behavior. And instead of looking after their future self and economically smoothing out their life by investing, they shy away from investing in favor of continuing their lifestyle, not giving up how they live. And obviously there's going to be adverse effects of that down the track. You'll see the check will be in the post for that kind of consumption smoothing later in life. In other words, it'll be very turbulent later in life for people who are not willing to give up stuff. Now, you could be in my position where you're giving up stuff, which I am, or I could go the opposite way and go, let's just cut off a economic limb and smooth out my life that way. There's 2 ways to smooth out life. You can sell an asset or you can become more frugal. At the moment, I've gone the frugal path because I'm kind of addicted to owning real estate. But if my life gets too boring and the Camry drives become too hostile, maybe I will consider economically trading up a property for just lifestyle benefits, a return on lifestyle. And I've probably not been in a position where I've done that. And interestingly enough, if we analyze the 3 forms of investment life cycle journey, you've got acquisitions, consolidation, and lifestyle. And in some respects, maybe I'm finding myself in a position where I can pull the trigger on a lifestyle play and actually just put a lot of cash in my bank and start living the life that I probably deserve. And that is, if I digest it, the first 20 years of my economic life were very, very difficult. I didn't make a lot of money. I had to be very, very frugal. There were times where probably my darkest period of my time was searching for coins in my couch, just trying to basically have enough money to, have a meal, going to an ATM and no money coming out of it. And if I look at the economic smoothing principle, how I've invested along my journey, I can see that those tough periods now are smoothing out right now in my life, when I can simply just pull a trigger and probably put, say, $1 million in my bank account, and I still would have enough assets to look after myself in a later in life in retirement. So what should I do? Maybe listeners, you can give me some advice. Should I pull the trigger and start to, I don't know, get even wilder with the way I live? Or should I just play it safe and economically ride the Uber and live a life in the back of a Camry? Because I'm economically smoothing out my life, consumption smoothing. So that's where we're at. What are you smoothing out? What are you willing to give up or chop off to change your life? That's probably the context of today's show. certainly I think Australians need to work out what to do next, because inflation's a little bit sticky, and it would appear to me that the political class here is not willing to push Australia into an uncomfortable space where it's basically economically not growing. Other countries are prepared to do that, have a short, sharp, basically recession to smooth out the economy. Here, it doesn't seem like it's going to unfold that way. So probably it's upon us as Australians to work out what we need to give up to work out where we need to go if we're in acquisitions. I guess from a legacy position, if you're going through legacy, maybe I'm going through legacy, do I just let it go, man, and start to, I don't know, have a bit of fun with some money? Interesting. All right, folks, that's it from me. Thanks for tuning in. As suggested, I've got 33 minutes to do a podcast, and this podcast is ending in basically minute almost 31. So we're on time. All right, folks, thanks for tuning in. I'll catch you next time. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.